Good evening, friends. On behalf of HDFC Mutual Fund, I extend a warm welcome to all of you. Hope you all are well and doing fine. Markets since beginning of this calendar year has been pretty volatile on account of various reasons: Ukraine war, inflation concerns, rising interest rates, etc., etc. When we talk about Indian market itself is divided into three distinct categories: large cap, mid caps, and small caps. Within the mutual fund industry, mid and small cap are main categories and command a large AUM in the respective categories. Together, they account for nearly 2,65,000 crores of AUM. To discuss the mid cap and small cap segment, we have today with us Chirag Setalvad, the fund manager for HDFC Midcap and HDFC Small Cap funds, and has more than 2 decades of experience as far as investments are concerned. He has been managing the mid-cap fund in the category with nearly 32,000 crores of AUM and has been managing this fund since 2007, since its inception. Another HDFC Small Cap, also another 12,000-13,000 crore fund, which has been managing for nearly last 7-8 years. So he has a rich experience in managing this small and mid-cap categories. And in this turbulent time, or we thought that let us have him on this call, on this webinar, to discuss not only the economic and market outlook, but also the future of these two categories in general as compared to a broader market, and the positioning of our mid and small caps. So with this, I will invite Chirag to take over. Chirag on this call are our distributors and their investors on this call. Would like to listen to your views or thoughts on the market, economy, and of course these two categories in specifically. And of course, Ram Kumar and Amay Devulkar, my colleagues, will be there moderating this call thereafter. So if you have any questions, please feel free to raise it in your question box, and we'll be getting it resolved for you post Chirag is done with his presentation, with his opening remarks. So over to you, Chirag.
Thank you, Ashok. Good evening, everybody, and thank you very much for taking the time to join this call. I hope the audio is fine and you can see the presentation in front of you. So I plan to speak for about half an hour, 45 minutes on the presentation, and I will cover broadly the economy, the markets, and then specifically the HDFC Midcap and Small Cap Fund. I will spend a little bit less time on the economy because I think the interest is more on markets and small cap, mid cap. But bear with me because there is obviously a strong correlation between how the economy is faring and how the market could possibly do going forward. So let us first start with the economy bit. And what we've shown here is GDP growth over the last 4 decades. And what is remarkable is over this period of time, growth has been remarkably consistent. It's been between 13 to 16%. Roughly half of that comes from inflation and the other half comes from real GDP growth. And this is despite a number of events which have transpired in each of these decades. Growth has been quite consistent. And most people don't relate to GDP growth. It's not a number which most people understand. So what is the relevance of GDP growth? I think it's 2 things I'd like to point out from this slide. The first is the consistency of growth despite the various adversities that India has faced. The second is this 13 to 15 number is what drives overall market returns. So when you speak to most market participants, they will tell you that if you hold for the long term, you should get returns of between 13 to 15%. And what is the sanctity of that number? Where does that number come from? Over a period of time, market returns mimic growth in corporate earnings. And corporate earnings, in turn, reflect overall GDP growth. So when GDP growth is 13 to 15% over a longer period of time, you see a similar growth in corporate earnings, and hence you see a similar return for the overall market. So I think that's the importance and relevance of this 13 to 15% GDP growth. Now, I think investors are obviously concerned in terms of where we are today and how returns can pan out going forward. So let me just briefly touch upon how markets can be thought about, and then we'll get more into the economy bit of the presentation. Actually, markets are very simple to think of. Markets are reasonable, which means they're fairly priced, markets are cheap, or markets are expensive. When markets are reasonable, you get returns which are close to these 13 to 15% numbers. That's the rate at which corporate earnings grow, and that's the kind of return you get. Valuations neither move up nor move down because they're reasonable. When you enter a market, when the market is cheap, you get enhanced returns because not only do you get this 13 to 15% growth, but you also get the opportunity to see valuations moving up, and hence your returns can move to 15, 20, 25%. And when you get in when the market is expensive, you get the earnings growth minus valuations deflating over a period of time, and hence your returns can become single digit, or for that matter, negative returns. So I think that's important to keep in mind. What kind of environment are you entering? Are you entering a market which is cheap, reasonable, or expensive? And we'll touch upon that in the market section. So these are some of the discussion points which we wanted to highlight as far as the economy goes. So I'll touch upon some of these in more detail, and the subsequent slides will cover it in greater depth. I think India is going through a remarkable transformation, and growth is expected to improve going forward. If you take the first point, Make in India is a theme which we are now seeing is gaining significant traction. In fact, I was reading the newspaper today in the Economic Times that more than 230,000 crores of schemes have been approved under PLI. And that's a significant boost to the manufacturing segment. The government has put in a number of regulatory measures which is helping the Indian manufacturing segment. One of the most significant measures amongst those is the reduction of the tax rate, which has fallen from roughly 35% to 25%. That itself has made India a lot more competitive. India also is a lot more competitive now compared to what China is, which is the point number 3 out here, which we'll get to in a minute. But I think India is benefiting significantly from a manufacturing standpoint. The second is we are seeing a huge shift in demand away from unorganized companies towards organized companies. And in India, this is very relevant because the unorganized sector is very meaningful. Depending on which industry you look at, the unorganized sector has a representation of anywhere from 25 to 75%. And what we are seeing is because of the impact first of Demon, then of GST, and more recently of COVID, we've seen a big shift in demand because the unorganized sector has been unable to cope with the challenges which have been presented. And hence you're seeing organized players are growing much faster. So in an industry where growth for the industry is 8-9%, the unorganized sector is growing significantly slower, and the organized segment is actually growing 12-13-14%. The third big story which is unfolding is the China plus one story. Now this story has been around for some time, but wasn't gaining much traction. And of late, we are seeing a lot more traction. India was always competitive compared to China from a cost standpoint, but Chinese costs have risen significantly of late. In addition to that, environmental compliance norms in China have become a lot more stringent, and that's made India a more attractive destination. But I think the most interesting fact is that we have seen because of COVID and because of supply disruptions, that most global MNCs don't want to rely on a single geography as a source of supply. And the immediate area they're looking to is India, because India is a large economy. It has a large domestic economy. It is highly competitive from a cost standpoint. It has incredibly strong engineering talent. And an English-speaking democratic country is certainly another attractive point in India's favor. Let me move on to how growth looks like from our overall GDP perspective. And we'll take about 10-15 minutes to cover the GDP part, and then we'll move to the market segment, which I think is more interesting to most people, so bear with me. But I think it's important to put the market in context of the economy. Right? And this year we've seen, or last year we saw the economy degrow because of the impact of COVID. FY20 was impacted in the last quarter. But this year we are seeing a meaningful improvement, and the economy is looking to bounce back to a growth of almost 9%. That is expected to remain at 8 to 9% even in the following year. And what we are observing is the leading indicators, things like power demand, railway goods movement, GST collections, all of these are pointing in the direction that demand is improving at a rapid pace. And that makes us positive from an overall economic standpoint, which also translates to a positive view on the market. I think one of the key factors which has changed and which is very relevant is the improvement in the banking system. Now, the banking system is really the grease of the economy. It pushes the economy forward. Without liquidity and financing, the economy cannot grow at a meaningful pace. And what we have seen is the banking system, particularly on the public sector side, was plagued by non-performing assets. But in the last couple of years, we've seen a sharp improvement in NPAs. So if you've seen NPAs, which used to be as high as 6% in FY18, have fallen to as low as 2% over the last couple of years. So there's a substantial improvement in non-performing assets. At the same time, we've seen capital adequacy jump to a 2-decade high. So what used to be 11, 12, 13% is now reached as high as 15%. And credit growth, which had bottomed out at 5, 6%, is starting to improve. I think this is an extremely important point because the banking system is in a much healthier place. And because the banking system is in a much healthier place, the ability to lend forward to corporates and to drive growth is much more in place. As a result, we expect private capex to pick up in a significant fashion. And the interesting thing is we've seen companies in the last 4 or 5 years delever to a significant extent, which means that they've paid off their debt to a meaningful extent, and leverage has fallen from 1 times to 0.7 times. And I think this is a meaningful occurrence over the last couple of years. Corporate leverage is at a 10-year low. We are significantly more competitive compared to China. And there is, as I said, a lot more interest of global MNCs to set up manufacturing capacity in India. And the government is also very supportive with a thrust on Atmanirbhar. So we think that India, which has lost out to China. So if you look at China's share of exports, it has risen to as high as 14%, and India has lagged and remained at 2 to 3% or 1 to 2%. We think that contribution will rise very meaningfully over a period of time. And if you see India's competitiveness, if you look at the chart at the bottom here, India's competitiveness, India's manufacturing wages are almost half of that of China. And at the same time, India's working population is rising while the working population of China is expected to come off, which means that India also has a large domestic market in addition to being able to service the global market. And hence manufacturing is something that we are very excited about. Capital goods as a sector is something we are very excited about. So banking was the first point we highlighted. And the reason we are highlighting banking and housing, these are large segments of the economy. And when these segments recover, the overall economy gets pushed forward. The second is housing, and housing is important because when you build a house, you create a lot of downstream demand. You create a lot of demand for steel, for cement, for consumer durables, for plywood, for pipes, and so on. And we are seeing today that the affordability of housing is at an all-time high, which means that when you look at home loan payment as a proportion of salary, of income, it has reached a multi-year low, which means affordability of homes is significantly higher. At the same time, we have seen mortgage rates come down while rental yields have remained more or less the same. So the trade-off between buying and renting is also now gradually moving more in favor of buying, because the ability to borrow at cheaper rates is an incentive to purchase a house rather than renting one. And because of RERA and other changes in the housing segment, we are now seeing a significant improvement post-COVID of new launches and new sales. And this bodes very well, as I said, for all the subsequent demand which comes when you build a house. The other remarkable thing in India is the change on the startup front. And we are seeing a significant number of investments being made in startups. In fact, last year we saw almost $24 billion going into startups. And it seems now a commonplace event. It seems almost every week that I read about a new unicorn taking place. In fact, last year in FY21, we saw 33 new billion-dollar companies take place in India. And I think it's great from an employment standpoint, it's great from an innovation standpoint, and it's great from a growth standpoint as well. And it attracts a significant amount of FDI. So from all standpoints, this is a new-ish development and something which is gaining further momentum. Now, of course, everything is not hunky-dory, and there are obviously risks out there. And I think this is part and parcel of investing in any market environment. There will always be risks. So let us run through some of the risks which are more prevalent today. And I think the chief amongst them, and they are somewhat interrelated, is the sharp increase in commodity prices. And this is remarkable because it is across the board. It is precious metals, so gold, silver, it is ferrous metals, it is aluminum, it is steel, it is copper. It is across the board that we are seeing metals at 5 to 10-year highs. And you look at the commodity index, which is the chart on the top left-hand side, the commodity index is almost at a 10-year high. And there's been a number of events which have resulted in this happening. We've seen a supply constraint partly because of COVID. We've seen more recently the impact of Russia and Ukraine. We've seen a sharp improvement in demand post-COVID. And we've seen the impact of COVID in China, which is a major supplier of a lot of commodities, taking out a lot of supply. And hence, a supply shock. This has been really a perfect storm as far as commodities go, and commodity prices are at multi-year, in fact, a decadal high. At the same time, we are seeing that also oil prices have moved up very sharply. With the movement towards more renewable energy, the investments in oil have been curtailed for the last couple of years. And hence, oil prices have also moved up. This has also been exacerbated by the supply constraints which have impacted commodities in general. The third is that we've also seen, because China's manufacturing or low-cost manufacturing impact is fading as China's costs go up, the deflationary impact of China manufacturing is also fading. In addition, we've seen huge stimulus taking place across both emerging markets as well as developed markets. And we see that in the charts at the bottom with the fiscal deficit as well as the balance sheet as a percentage of GDP. So really, countries across the world have pumped in significant amount of money to bolster their economies because of the impact of COVID. And this large fiscal and monetary stimulus and this large liquidity infusion into the global economy has also impacted asset prices and commodity prices. And I think the last risk which is out there, especially today, is the risk of Russia and Ukraine, and of that conflict gaining further momentum. And I think that is something which is difficult to predict, but is certainly something that has to be watched out very carefully. Now, I think these risks today, these are the risks. But I think for me, the interesting part is when I look at my career over the last 20 years, there have always been risks. And we've always had a slide in our presentation talking about risks. But the interesting thing is that these slides keep changing significantly. So I can tell you one thing, the slide of today will not be the slide 2 years from later, 2 years from now, or 3 years from now. There'll be a brand new set of risks. So these risks will come and a brand new set will come and go, and a brand new set of risks will emerge. So I think dealing with risk is part and parcel of investing in equities. And the way that I like to think about it is risks will always be there. There are sometimes when the focus is more on risk and sometimes when it is less. And when the focus is more on risks and markets are jittery and everybody thinks that the world is coming to an end, that's the time to put meaningful capital to work. So if you look at it at the bottom of COVID or the bottom of the market when COVID is at its peak, people were incredibly nervous. Nobody knew what was going to happen. It was a fantastic time to invest. People didn't have necessarily the metal to invest in those markets, but that was a fantastic time to invest. At the same time, if you look at the bottom of the financial crisis, again, there was a tremendous amount of uncertainty, but a fantastic time to invest in markets. So I think risks are part and parcel of investing in markets. You can't get away from that. And when these risks manifest themselves in a significant fashion, when the markets are doing terribly, when the markets have been bombed out, those are the times when it is hardest to invest, but the most rewarding. So I think as investors, we typically invest in two forms. We do a systematic investing program where we consistently invest. And I think that's a fantastic way of investing, and we'll touch upon that later on in more depth. But I think you have to supplement SIP investing and regular investing with occasional lump sum investing. And I think one should be more aggressive on lump sum investing depending on the overall environment. The tougher the environment, the worse the news, the more despondent you see people on CNBC, the bigger the lump sum investment that is justified, and vice versa. When everybody is doing fantastically, when the newspapers are raving about emerging India and new India and so on, and when the anchors on CNBC are delighted, that's the time to be nervous. When everybody around you is making money, be nervous. When everybody around you is complaining that the stock market is a casino, be excited. So it's always important to have a contrary view. So risks are something which are part and parcel of equity markets, but I think it's important how we deal with these risks and how we invest depending on the magnitude of these risks and their impact in the markets. So that concludes more or less the economy section. And I wanted to move now to equity markets. I think that is what everybody's interested in. So let us briefly touch upon where are valuations today, right? Whether it's for the Nifty, for the mid cap and small cap, we'll cover all three. Is the market cheap? Is the market expensive, or is it somewhat reasonable? So the way we look at valuations most commonly is by looking at the PE multiple. So we'll start with the Nifty 50, which is a barometer of large caps. So what you can see here is, this is what the PE, how the PE has ranged over the last 10 years. At the bottom, the PE went to, well, close to 10 times. But if you go back even further in time, the bottom has been, at the time of the financial crisis, the PE multiple went to as low as 10. So at the bottom, the PE multiple goes to 10. At the top, if you look at it over a 20-year period, the PE multiple has gone to as high as 30, 35 times, and the average has roughly been around 17 times. Today, the Nifty is trading at 19 odd times 1 year forward earnings. That's about a 20% premium to its average. At a 20% premium, I don't think that the market is cheap. I would not agree with that. But at the same time, I don't think the market is very expensive. And let me try and explain why that is. A 20% premium, let's assume that over a period of time, valuations normalize. So 20 comes back to 17 over, let's say, a 3, 4, 5 year period. That means you are sacrificing roughly 2 to 3% of returns. A 20% over a 5 year period roughly is 3.5% per year. Now, typically equity markets, going back to the earlier slide on GDP growth, typically markets give returns in line with earnings growth, in line with GDP growth, which is typically around 14, 15%. And we hope that funds endeavor to do better than that. So let us keep the alpha bit out. Let us keep the outperformance out of it. But at 15%, we are compromising maybe 3.5%. So we are still looking at a reasonable low double-digit return for large caps. I think expecting 11, 12% returns is still a reasonable expectation. And in this environment, I think that is the best asset class to be investing in. There is no other asset class which is as tax efficient, which is as liquid, where you can really continuously invest in a lump sum fashion over a long period of time and have transparency and liquidity. So I remain extremely optimistic. But having said that, I think one has to temper down one's expectations, because we're not in an environment where the market is cheap, but we're not at the same time in a market environment where it is very expensive. We are just marginally expensive or somewhat expensive. Now let us move to mid caps, because I think there's a lot of excitement and interest in mid caps, and there's been a huge rally in mid caps over the last couple of years. And obviously there is a lot of concern as a result of that. And there is one segment of the market which thinks that the rally is too much and people are nervous. There is, of course, another segment of the market which thinks this is just the beginning and we have a long way to go, and this trend will continue. So let us just look at it. Let us put a longer term perspective to it. I think as investors, very often we get caught up in the short term. We look at the last 1 year, 2 years and say, oh, fantastic returns. Let us either extrapolate that or assume that that will not continue. But let us stretch the time horizon. Let us not look at the last 2 years. Let us look at the last 5 years, which is not a terribly long period of time, but at least longer than looking at a couple of years. So what we've seen is FY21, the market doubled. The mid-cap index doubled. FY22, it continued to do well, and we had a 25% return. But what we forget is FY19 and FY20, the market corrected by almost 30-odd%. So after falling sharply, the market has recovered sharply. So when you look at it over an extended time frame, when you extend the time horizon to 5 years, you see that the Nifty returns are roughly 15%. And if you look at the chart at the bottom left-hand side, that's broadly in line with GDP growth. So the GDP growth of 12 to 15%, mid-cap returns of roughly 15%. So mid-caps have, in the last 5 years, done in line with decadal GDP growth. So it's not that, yes, mid-caps have done fantastically for the last 2 years, but when looked at over the last 5-7 years, returns are more in line with what you would think is reasonable. So I think that gives me a lot of comfort. So I think that's the first point. I think the second is that when people think about mid-caps, so this is something that I wanted to sort of put the spotlight on a little bit. People think that mid-caps are a high-risk segment. And I think there is significantly higher volatility in mid-caps compared to large caps. And on the right-hand side, you see those numbers. So yes, mid-caps are more volatile. But what people don't necessarily realize is the returns are commensurately higher. So volatility is higher and returns are also commensurately higher. And as a result, risk-adjusted returns, the return when looked along with risk is actually quite similar. So Nifty has given a return of 16% with volatility of 16-17%, and mid-caps have given a 4-5% higher return with 4-5% higher volatility. So mid-caps, for those who are invested for a longer period of time, yes, there is higher returns, but it is accompanied with higher volatility. So let us turn to mid-cap valuations. To see, we looked at large caps and we spoke about how the compromise in returns could be a couple of percent, but how overall returns are still reasonable when looked at it from a medium-term perspective. So how do mid-caps stack up in that context? So today, let's look at the first of the chart on the left-hand side, which is the P of the mid-cap index. And what you can see here, the average P has been roughly over the last 10 years has been about 18 times. Over the last 5 years has been 20. And we are currently at 22 times. So we are a marginal premium to the 5-year average. But I think looking at 5 years is not the right number, because the last 5 years, 2 of the last 5 years have been when the bull market has really been active. So you need to stretch your time horizon and look at a longer period of time. So let us look at 10 years. I think 10 years is a good enough period. It captures a bull market, captures a bear market, and so on. And when you look at that, the mid-cap index is similarly to the large cap index is trading at roughly a 20% premium. So this 20% premium, again, similar to large caps, it means that 20% over a 5-year period, you're roughly compromising on 3.5% of returns compounded per annum. And this is a category which actually gives slightly higher returns. We spoke about it earlier that if you look at the previous slide, 16% odd for the Nifty, you take away 3-4% and you still get to 12%. 20-odd% for mid caps. So you take away a couple of percent, you take away 3 to 4%, and you're still at a reasonable number. So I think investors should look at it this way. Yes, markets have rallied. Markets are no longer cheap. They're a little bit on the expensive side. That will take away a little bit of our returns. But nonetheless, the outlook for returns is still quite healthy. Now let us for a minute look at mid cap versus large cap, because I think this is another debate out there and people would like a perspective. How do mid caps compare to large caps? So we've looked at the mid-cap PE relative to the large cap PE. And if you look at the chart on the top right-hand side, what you see is the average premium of the mid-caps to large caps has roughly been 3%. And today it is roughly 13%. So it's about a 10% premium to where it has been historically. So it's not a very large number. Are mid-caps more expensive than large caps compared to history? Yes. Is it significantly more expensive? No. So I think we should dispel that. And like I said, we should look at the mid-cap rally not in the context of 2 years, but in the context of 5 years and 10 years. What is also interesting is the PE breakup. So one is to look at the PE multiple and say 22 times. It's a little bit more than average. But I think it's interesting to break that up. And when you break it up, what you realize is there are a number of companies which are expensive. So when you see PE multiples above 40, let us call that expensive. So the number of stocks, there is almost 30% of the index, which is expensive. And it's more than 40 PE on a 1-year forward basis. But there is also commensurately a significant portion of the market, which is trading at a multiple of less than 20, again, about a third. So the market is barbelled. It has a part of the market which is expensive, a part of the market which is reasonable, and then stuff which is in the middle. So as a portfolio manager, we look at the market is a little bit on the expensive side. But we have the ability to pick and choose stocks which have not rallied, which have not participated to the same extent, and still create a portfolio which is reasonable. When we get to the mid-cap fund and the small-cap fund, you will see that that's exactly what we have done in the HDFC Midcap Opportunities Fund and the HDFC Small-Cap Fund. And that is why we are very excited about the prospects of these two funds, because we have curated portfolios with good returns, with good growth, and where valuations are sensible because we have focused on that part of the market where the rally has been less. Now, having spoken about large caps, let us move to small cap. Having spoken about large and mid, let us talk about small caps. Now, again, let us look at this PE of small caps. And the average, as you can see, currently we are at 17 times. The average over the last 5 years is 16. So we are in line with the last 5 years. But once again, let us stretch beyond 5 years because that's a bull market period. Let's look at the last 10 years. 14 versus 17. So the premium is even a little bit less than what it is in mid caps. So small cap valuations, despite the sharp rally, is not as expensive as you would think. And again, we are talking about a similar compromise of a couple of percent of 3% to 3% in terms of returns. And of course, as you would expect, typically mid caps and small caps do better than large caps. Small caps do even better than mid caps with greater volatility. So again, the outlook is diminished compared to what it would be otherwise, but it is still a very positive outlook. Now, when you look at small caps, the other question, of course, is how do small caps compare with large caps? Now, here's quite interesting. The average discount, so mid caps, small caps typically trade at a discount of about 19% compared to large caps. And today that discount is about 14.9. So it's not very far from where the historical number is. It's only a 5% difference. So small caps compared to large caps, actually the discount has not changed very much. So the argument can be made that yes, small caps have rallied, large caps have also rallied, and the discount has not changed much. So it's not that small caps are incredibly expensive. And again, when you look at the breakup of PE, when you look at the constituents of this PE, it's even more scattered than what you've seen in the mid-cap index. So what you see here, what you see here is there are a number of companies, about 20% of the index, which is quite expensive, trading at more than a 40 PE, but a significant portion of the market still trades at a reasonable PE, which is below 15 times 1 year forward. So I think there is still an opportunity. In fact, I think there is even more of an opportunity in small caps. So I think when you look at small cap investing, I think you have to keep in mind that risk and returns go hand in hand. It is true for equities. It is true for asset classes in general. You take more risk, you get more return. That's why equities are more volatile, but give you more reward compared to fixed income. That is why mid caps and small caps typically over a period of time tend to do better. But again, that is accompanied with greater volatility. So the way to invest in markets and to manage this volatility is to invest systematically. So you capture market highs, you capture market mids, you capture market lows. At the same time, I think it's very important to enhance that by looking at lump sum investing. And you typically put in lump sum investing when the market is doing terribly, not doing so well, or doing even average. You would not want to put in lump sum when the market is doing particularly well. So this, I won't touch upon the slide too much, but this is really, again, highlights what we spoke about in the earlier valuation slides, which is, this is overall market cap to GDP, and you can see it continues to be in a range. It's closer to the top of the range, but it is not broken beyond that range, which again bolsters our argument that yes, markets are a little bit on the expensive side. You will compromise a couple of % of returns, but still, nonetheless, the outlook for returns continues to be quite positive. Let us move to sector valuations for a bit. I think everybody is interested to hear about how various sectors are positioned, valued, and so on. So let me just briefly touch upon sectors which I think are reasonably priced and those which are more expensive. So what you see on the right-hand side is you see the valuation of these indices compared to where they have traded historically. So the stuff at the bottom is what is cheap. So metals and tobacco clearly cheap, trading at a 25-30% discount to what is the average 10-year long-term average. Stuff at the top is expensive. So consumer durables, IT, auto, and FMCG, despite underperforming, remains expensive. And things in the middle are reasonably priced, which is oil and gas, cement, utilities, pharma, and banks. And the same is depicted on the left-hand side, which is the P multiple of these sectors over a period of time. And as you can see, the consumer and IT space is more expensive than where it has been historically. Private banks are in line with historical averages and metals are cheap. Now, the only clarification I would give in this, I don't want to really give a sector outlook as such, but I do think that financial services, as I said, are on a significantly improving trend. We spoke about NPAs coming down. We spoke about the liquidity in the system being better, capital adequacy being higher. And we spoke about that lending is picking up. Metals, which is cheap, is a number which should be looked at with a little bit of skepticism. And the reason for that is metal stocks are cheapest when the earnings are the highest. And earnings are typically the highest at cyclical tops, right? So when steel prices go up sharply, steel companies' earnings go up, the P multiple looks low, but are those earnings really sustainable? So I would be a little bit careful when looking at P multiples for cyclical businesses like metals. But I do think that pharma, banks, these are large segments of the market for that matter, oil and gas, cement and utilities, all of these segments continue to remain attractive. And these are the parts of the market where we are overweight on at the current moment. Let me briefly touch upon profit growth, and then we'll move to the funds. So profit growth is looking on the way up. We've seen a sharp FY22, FY21, we saw meaningful earnings growth of 18 to 34% despite the impact of COVID. This year, earnings expectation is 17% and next year 12%. So we're still seeing reasonable earnings growth. We're seeing profitability, which is the chart on the left. We're seeing profitability on the way up. We're seeing losses coming down. And there is still a lot of variability in sector valuations, which gives us as fund managers the ability to add value to our portfolios. Let me summarize the market view, and then we'll move to mid-cap, small-cap fund in particular. So as far as the overall outlook goes, India's growth outlook is certainly a lot more positive, right? We are seeing a healthy outlook for infra and private capex. Consumption is stable. Housing demand is improving. Balance sheet of banks is very strong. Corporate balance sheet is also very strong. And the feedback we get from companies, we speak with 300-400 companies, if not more, during the course of the year. And the positivity that we see in companies, I think, is something which is very reassuring. Valuations have moved up. Obviously, markets have rallied. Valuations have moved up. But like I said, it's not that we are in a very expensive zone. We are a little bit expensive. We will compromise a couple of percent. But the outlook for returns is still in decent double digits. And outlook for GDP growth continues to be positive. The risks out there are elevated commodity prices, geopolitics, obviously, rising rates and inflation. And let me just give you my perspective. And of course, only time will tell how these things pan out. But I am a big believer, and I think we've seen this over the years, of cyclicality. And commodity prices today are high because of this perfect storm. We are seeing because of the impact of China, because of the impact of demand recovery of COVID, because of supply constraints. I mean, everything that you could possibly want for high commodity prices is today in place. But I think this will unwind over a period of time. As the impact of COVID in China wanes, we will see China supplies coming back into the market. As interest rates rise, and as the base effect of COVID goes past, I think demand will also slow down globally. So I think demand will slow down a little bit. Supply will come back from China. I think some of these geopolitical issues will get readjusted or sorted out, hopefully. And that will also bring back supply of certain of the agri commodities in particular. I think there will be more capex. So obviously, when metal companies are doing so fantastically, or commodity companies are doing so fantastically, they will invest more in expansion, because right now you're making fantastic returns. And as those capacities come on stream, and of course, it'll take some time, but even the expectation of capacity impacts prices. And there is also this huge liquidity, right? And governments have pumped in significant amounts of money. And as that liquidity is now withdrawn, and you've seen the Fed already announce rising interest rates, the Fed has already announced a sucking out of liquidity. That liquidity impact on commodity prices, which is the speculative impact, more of the speculative impact, that will also tend to come off. So I do believe that commodity prices will come off. It's difficult to time it and look at the trajectory of that, but I think commodity prices will come off, and that will take out one of the biggest risks which are currently impacting today's markets. I think this is very important. It's 3 simple points, but it is probably for me the most important slide in this entire presentation. Most important to keep in mind is asset allocation. At the end of the day, equities will typically give you 12 to 15% returns. Fixed income will typically give you 5 to 7% returns. How much money you have in equities and how much money you have in fixed income or debt is the most important driver of returns of your portfolio. I think that is key to keep in mind. I think most people are more focused on whether to invest with HDFC or ICICI or Kotak or so on and so forth. And they miss the big picture. They miss, while focusing on the trees, they miss the woods. So you need to first get asset allocation in place. That is the primary driver of returns. So if you choose the right fund, but if you get your asset allocation wrong, your overall outcome will be suboptimal. So please focus on asset allocation, which should be a function of your age, your liquidity requirements, your outlook, and so on. Your risk appetite. Invest for the long term. Nobody has made serious money by getting in and out of the market. It happens occasionally, but it doesn't happen frequently. When you look around us and you see people of the generation before us, none of them made money by saying, we got in, we got out, we got in, we got out, we got in at the bottom, we got out at the top. We did that and we kept doing that. And that's how we've made our money. That's not the story. Nobody tells you that story. The story always is we invested, we stayed invested, we forgot in some cases, but we stayed invested, and that has worked well for us. So I think investing for the long term is key. And the third is invest regularly. I've said this earlier in the presentation as well. Invest through SIPs. That allows you to capture top markets, bottom markets, mid markets, and invest lump sum when markets are doing badly. Be contrarian in your thinking. And I think we all have that ability. You don't need a fund manager to tell you when the market is phenomenally expensive or phenomenally cheap. At the time of COVID, it was very hard to invest, but that was the best time to put money to work. You would have more than doubled or tripled your money from the bottom of the market. Same thing with the financial crisis. So when times are tough, it's time for investors to be brave and put more money into markets. So a little bit running out of time. So I will, in the interest of time, move to the small cap fund first and then briefly touch upon the mid cap fund. I'm extremely excited about the prospects of HDFC small cap fund. So let me tell you, I think the category itself has huge advantages. So the way we define, or the way all of us as an industry define large cap, mid cap, small caps is large caps are top 100 companies, mid caps are the next 150, and small cap are the balance companies, which makes it very interesting because small caps are now 1,500 companies. Companies below 16,000 crore market cap today are all considered to be small caps. So there's a lot of choice, right? Unless 100, 150 compared to that, you have almost 10 times the choice in small cap companies. And these are not necessarily fledgling businesses. These are businesses which are strong in the areas in which they operate. They have strong management. They have good debt management in place. So by picking and choosing the right businesses, I think there is still a lot of runway ahead for small caps. Now, why do small caps do well over a period of time? What is the scope for outsized returns? I think there are 3-4 things. One is as the size of a business increases, more and more people cover the company. There is more familiarity with that business. So as an example, what we showed on the right-hand side is for large caps, typically there are 34 analysts per company covering it. For a mid cap, it drops to 18. For a small cap, it drops to a 7. And I've seen plenty of small caps where there is 1, 2, or no analysts covering it. So in life, wherever there is less competition, it's easier to excel. If you're running a race with 34 people, as opposed to running a race with 5 people or 2 people, or if you're the only person, then the outcome changes quite significantly. The second is institutional holding goes up as companies get bigger. As you move from smaller to mid to large, the participation of FIs and DFIs increases, and that tends to give the business a better valuation. The third is as businesses grow in size, they tend to have better disclosures. The quality of the annual report increases. They have more frequent analyst meets and conference calls. And all that leads to greater familiarity and a higher multiple over a period of time. And all of this results in stocks which are smaller and mispriced getting re-rated upwards, which gives the opportunity not only to capture earnings growth, but also to capture valuation upside over a period of time. What is also very interesting is that small caps give you an opportunity to invest in a lot of sectors, as opposed to large caps. So what you have here is the exposure of large caps and mid caps and small caps to various segments. And what you can see is large caps, the concentration is amongst 4 or 5 or 6 big sectors: financial services, software, petroleum products, consumer durables, auto, and things of that sort. Top 10 industries is 85%. So really, when you're investing in large caps, you're exposing yourself to a handful of sectors. When you look at small caps, the diversity changes very substantially. Now, all of a sudden, you're including defense companies, construction companies, textile companies, media companies, chemical companies, healthcare services, and so on. So I think the opportunity to participate in a wider number of businesses gives you more stability in some ways, gives you more opportunity to participate in high growth businesses and segments. And I think this is one of the key advantages that the small cap category offers. How do we run a small cap fund? We focus on good quality businesses. At the same time, we want to invest at sensible valuations, minimize our mistakes, We don't run concentrated portfolios. We run diversified portfolios. We are typically 65 to 100% in small caps and normally 80 to 90% in small caps. So this is a genuinely small cap fund. We're not a small large, we're a small cap fund. So typically predominantly small, we may have an element of mid and a very small, if at all, an element of large. And it's not easy always to do this. You want a high quality businesses at reasonable prices. So I think that's something that everybody would endeavor for, right? No fund manager is going to tell you I'm investing in terrible companies at all kinds of prices. So the proof of the pudding is actually in the numbers. So let us look at the numbers of the small cap fund. So you have 63 companies in the portfolio. This is compared to the benchmark, which has 250. We are investing at reasonable prices. So you look at the PE multiple, the trading multiple of 18 versus 26 times, forward multiple of 13 versus 18 times. So we are significantly cheaper. But we're not compromising on quality. It's not that we are buying cheap and poor quality companies. The return on capital employed is actually higher than the benchmark. So return on equity is 13% versus 12%. Return on capital employed is 16% versus 13%. So better quality businesses at reasonable prices. And we're not compromising on growth. Growth is also the same at 32, 33%. And we have managed to do this by getting into smaller companies. And we have seen that our weighted average market cap, which is 10,000 crores, compares similarly to the benchmark, but is significantly below what you see elsewhere amongst our peers, which would be closer to almost double our size. So I think this is a very powerful slide to show how we invest. And I'm extremely positive for the long-term outlook of the small cap fund. And our performance is also, while of course we've had good years and bad years, our long-term track record has been very strong and we've outperformed the benchmark by almost 6%. That takes me, I've almost taken an hour. So let me quickly move to the mid-cap fund. And I'll spend a little bit less time on this just because we are running out of time and we want to have a Q&A session. We follow an approach which is similar to the small cap fund. It's a stock specific approach. We create the portfolio on a bottom up basis, good quality businesses, and we hold it for a long period of time. We hold our businesses for 7 years, 8 years. And we invest predominantly in mid caps. This is not a mid cap, large cap strategy. It's a mid cap strategy. And similarly to the statistics you saw in small cap, what you can see here is we are cheaper. So we have invested in companies. You can see that our P multiple of 18 versus 25, we are cheaper than the benchmark. Our return on equity is meaningfully higher, 3 to 4% higher. Our growth is lower. So we have chosen to invest in lower growth businesses because we are finding that high growth businesses have become extremely expensive. And the risk reward is better in businesses where the growth is still strong. 20% is not a small number. Growth is still strong, but it is not super high growth at super high valuations. It is good growth at good valuations. And I think this will do extremely well for us over a period of time. Again, while our performance may have varied in good years and bad years, depending on which period you look at, our long-term track record remains something which is still quite good. And we have beaten the benchmark by almost 2 to 3% over a longer period of time. And I'm, again, extremely positive for the outlook of this product. So that is the end of the presentation. We'll move to Q&A, but I think I'd just like to highlight 2-3 points. The first is look at asset allocation. It is extremely important. Invest systematically, invest more in downturns. Yes, mid caps and small caps have rallied, but keep that rally into a 5-year perspective and you'll realize that, yes, while it is expensive, you're compromising just a couple of percent and the outlook for returns is still quite positive. With that, I'll turn over to my colleagues Ashok and Ram. Thank you very much, everybody, for attending this call. And we look forward to your participation in Q&A. Thank you.
Thanks, Chirag. It was indeed a very comprehensive and a wonderful presentation. Your connection is showing rather. And just for the viewers, Chirag manages cumulatively 70,000 crores of AUM. So that's a large, of course, of which mid and small is significant size, nearly 43,000 crores. So that's a pretty large AUM that he manages himself. And that is all accumulated because of the wealth that he has created for his investors. So without much time ado, Ram, over to you for questions and answers.
Thanks, Ashok. Chirag, yes, I would like to repeat that it's a great presentation that you have made. Many viewers have mentioned that. To begin with, in terms of the questions that we have, I would like to take Mr. Harish. His question is that it's about the rising interest rates both in India as well as globally. How do you see banking and financials as a sector do well in this scenario? Do you think that high interest rates would lead to lower demand for borrowing? Chirag, you can unmute.
No, in fact, I think the outlook for banking and financial services is very positive. So one is, let us look at the growth and the fundamental part of it, and then valuations, because both have to be looked at jointly. The valuations, we looked at the sector slides, valuations are in line with long-term averages. So this is not a sector where you're getting in at expensive valuations. Valuations are in fact either sensible or attractive. So that's something that is in our favor. The second is, as interest rates rise, I think the ability to invest of a company, actually interest rates is not the dominant factor. The dominant factor is the ability to forecast demand. If you feel that demand is there, if you are confident on demand, if you are confident on regulation, if you are confident on your profitability, then you are okay whether you are investing at a 7% interest rate or a 4% interest rate or 8% interest rate. I think is less relevant. What is more important, companies will not invest at 3% if they don't see demand, but they will invest at 8% if they see demand. And I think today companies are a lot more positive because of the external environment, because of the internal environment. And we spoke about PLI and so on and so forth, and China plus one and unorganized versus organized. I think the confidence, and we get this when we speak to companies. And we speak, as I said, to 300, 400, 500 companies in a year. The confidence is high. Companies are ramping up CapEx. They've delevered over the last couple of years. And now that leverage is gradually coming back into the system. Most companies have exhausted the ability to grow in their current facilities, which is called brownfield expansion. So they're now going to greenfield, to new locations to grow. You need more capital. And I think banks are also more confident to lend, having gone through the NPA cycle and the worst is over and their capital adequacy has gone up. So I think growth will improve, and rising interest rates are actually supportive of margins, because what you see is deposits typically reprice slower and you will see lending rates reprice faster. And a lot of that is because of linkages that has been put into place. So I think that actually financial services will do well.
Thanks, Chirag. So I'd like to take one question from Mr. Varun, who is asking about your view on PSU companies. As the valuations, he believes that it's lower on a relative basis in that space. Do you see significant opportunities in PSUs, and your thoughts on PSU utilities, if you can share?
I won't get into specific utilities because I think that may be a bit unfair, and we want to be careful from a compliance standpoint. But let me give you a broader answer. I think it's a bit unfair to categorize all PSUs as the same. You would not do that for private sector companies. You would not say this is a good time to invest in private sector because there are so many types of private sector businesses. For that matter, even within the same sector, companies can have very different profiles. So I think the profile of a utility is very different from a defense company, which is very different from a financial services company, all within the PSU space, which is very different from a shipbuilding company, which is very different from other types of businesses, construction businesses within the government ambit. So I think in general, I think that observation, Varun, is correct, that PSUs are attractively priced. Yes. But I think you have to be still careful. You have to pick and choose well-managed PSUs, because poorly managed PSUs will remain cheap. But I think there are a number of PSUs which are still mispriced. There's an impression created that PSUs are badly run. And as a result, the valuation for PSUs as a whole comes down. But there are well-managed PSUs as well. There are utilities which, as without getting into valuations too much, which are extremely predictable businesses, but are struggling not struggling with where the valuations they're not getting rewarded in terms of valuation. So I think let me summarize it this way. I think the overall outlook for PSUs is quite positive. I think within that, utilities, some of the defense companies and some of the public sector banks in particular stand out. But I think you have to be stock specific. But I think that overall segment gets painted with the same negative brush very often, and that creates an opportunity. Whenever people think of a sector or a segment of the market in a herd fashion, it creates an opportunity either to buy or to sell.
Thanks, Chirag. Quite a few people have written about the size of a particular fund, whether it will have an impact on the performance. So one such question is from Mr. Neeraj, who is saying that how do we see the performance of a fund improving or getting affected by its AUM size whether it puts pressure on the performance. So that is one part of this question. Probably you can, and there is also, he has also mentioned about automobile sector in terms of your view on the auto sector as well. First on the size.
So I don't think size is as much of a constraint as people think it is. So let's think about why size is a problem or could be a problem in mid caps, small caps. You become too large in size, you tend to diversify too much. You go from 40 companies, 50 companies, 60, 80, 100 companies, and so on. So the tail becomes too long of your portfolio. That's one risk. The second risk is the way you invest changes. So you want to invest in a certain fashion, but because of size, you start changing the way in which you invest. So I think that's the other risk. And then you start investing in larger companies, right? It's a larger fund. You can't do small cap, mid cap. You get into mid large and larger and so on. Now, keep in mind, so let me give you some statistics. So none of that has happened in our case. We have a very tight portfolio. It remains quite tight. We have invested in 65 companies. It's 65 today. It was 65 2 years ago. It was 65 10 years ago. So we have not over diversified. It's not changed. Our market cap orientation is the lowest in the industry. So this is a 30,000 crore fund, which is investing on average in sort of 18, 20,000 crore market cap. And when you compare to our peers are, some of them are half our size, 1/3 our size, 1/4 our size, but are investing in much bigger businesses. So we have not gravitated to larger businesses. And at the same time, we have not changed our style. We showed you that our PE remains below average, our ROE remains above average, and our growth remains reasonable. This is a strategy which we've followed for the last 10 years, 15 years, and that strategy hasn't changed. If this were true, then the simple part would be every year, look at the mid-cap category, buy the fund with the smallest AUM, sell the fund with the largest AUM, and you'll do fine. But it doesn't work that way. The funds which do well gain a lot of investor interest and following. That's why the AUM also grows in size. So people who do well get the benefit of that inflow. And I think I don't think that's, for us at least, I don't think size is a challenge. So that's the first part. As far as autos go, I'll put it this way. In mid cap, small caps, which is where I tend to spend more time, the focus is more on auto ancillaries as opposed to auto OEM. And I am a big fan of auto ancillaries for the following 2-3 reasons. One, the business is a lot more diversified compared to OEMs, right? Which is the original equipment manufacturers, the car companies and the truck companies and so on. So unlike a truck company, which is a truck company, or a car company, which is a car company, an auto ancillary will have domestic plus exports. That gives level 1 of diversification. Within that, it'll supply to 2-wheelers, 4-wheelers. Within 4-wheelers, it'll be cars and trucks and so on. So there is, in that sense, a lot more diversification to the business. The return on equity of auto ancillaries, in my mind, is better than what I see in OEMs. So, and managements are very strong. So strong managements, good ROEs, diversified business, export India opportunities, I think they will do extremely well over a period of time. So I'm a fan more of auto ancillaries and auto OEMs, and that's also because of the mid-cap, small cap orientation of these businesses. So I think but you have to pick and choose. You have to pick and choose well-managed companies. I think making a generic statement is always something which I'm careful about because within auto ancillaries, there are some extremely well-managed businesses, but they're too expensive. I wouldn't necessarily invest in them. There are some extremely cheap businesses, but they're not well-run. I won't invest in those either. So you have to look at well-run businesses available at sensible valuations. You can't take the risk of the business. You can't take the risk of the valuations either. So I think that's how you have to strike a compromise. But I think in general, the auto ancillary space can do quite well.
Thanks, Chirag. There are quite a few viewers who have asked between the comparison of large caps as a segment versus mid cap and small cap, given the fact that there's probably higher risk involved in investing in mid caps and small caps relative to large caps. What kind of return expectations can be set for investing in mid caps and small caps? And also there is a particular question, I'm not able to look up the name of the viewer. The question is that, do we have to consider a longer investment horizon for investing in small caps as compared to large caps?
So let me start with the last question. That's a great question. That's not been asked for quite some time. I think, yes, I think you should look at a longer horizon. Mid-cap, small-cap returns tend to be higher, but the volatility is also higher. If you want to mitigate the impact of volatility, it's better to have an extended time horizon. So yes, if you're looking at X number of period for large caps, I think you should stretch that out by a couple of years for mid caps and small caps. So yes, longer horizon is important. Mid caps and small caps tend to have higher returns, but also higher volatility. We spoke about that earlier, and we showed that in an earlier slide. I think it's also important to point out the ability of funds to add alpha. So what is alpha? A very fancy term to show about excess returns. I think the ability to add excess returns in small cap, mid caps is greater. So for a minute, let us assume that mid cap, small cap indices give the same returns. So let us take that as the base case, though actually the returns will tend to be higher. But let us assume that for a minute that everything gives the same return. Even then, funds in the mid cap and small cap category will tend to do better because the ability to add value from an analytical standpoint, from an overall understanding standpoint, less competition, all of that adds to greater excess returns in funds. So even if the category returns were X and both return the same, the ability to add a couple of percent higher in mid caps and small caps is there. And that adds up to a lot over a period of time.
Thanks, Chirag. So again, few questions on the performance comparison that you made with vis-a-vis the benchmark. There are people that in a category like small cap and mid cap, wouldn't it be relevant to compare it with peers? Of course, we cannot be going into the details of what exactly peers are doing, etc. But sometimes it becomes a requirement, especially from the audience and the viewers, that they also expect us to be a better performing fund as far as the peer comparison also is concerned. So how, and also especially in a category like small caps, two portfolios are similar because the universe is so huge. So how do you tackle this challenge of standing up to the performance as far as peer comparison is concerned?
I'm not sure what exactly the question was, Ram, but let me try give a stab at it. So I think, relative performance versus peers is something which will vary year to year, right? So our endeavor is the following. We endeavor to try and be in quartile 1, quartile 2 at most points of time. There will be times when we'll slip out of that, but if we endeavor to be in quartile 1, quartile 2 consistently, then over a period of time, we'll do well. There will, of course, be times when we'll do extremely well, and there'll be times when we'll be doing not as well. And I think that's the nature of this business. But I think the key is to stick with your convictions, not to chase what the market is doing. You have to do what you think is your strength and what you are good at. Sometimes the market will appreciate a little bit more. Sometimes the market will appreciate a little bit less. In fact, today is an environment where the market has been, for the last couple of years, obsessed with growth. And I can understand why that's happened because interest rates have been very low. So low interest rates are good for valuations of growth businesses. As interest rates rise, the pendulum swings more towards value. It doesn't have to go into deep value, but it moves more towards businesses which are growth at a reasonable price. That is our sweet spot. So that's where we operate, which is more in companies which are growth at a reasonable price. So I think actually this rising interest rate environment, etc., places well to the way in which our funds are positioned.
Thanks, Chirag. So I'll read out a question on green energy and EV theme. What's your view on those themes? And do you have exposure to such themes and any other new age businesses that have got listed over the last few quarters?
So we have lower exposure. So let me start with EVs. I think EVs is clearly a trend which is here to stay. There's no doubt about it. To the earlier question about auto ancillaries, we are very careful about investing in auto ancillaries which are disrupted by EV, right? So we want to invest in businesses where they can, if 75% of a business is going to be disrupted by a move away from ICE to EV, then that's something that we're extremely wary of. The businesses that the automobile ancillary businesses that we're investing in are either EV beneficiaries or will manage the transition somewhat well. So I think EVs is a trend which is here to stay. It's interesting. And as I was leaving my building today, I saw two Tata Power charging stations. Right. So it's here. It's coming. It's visible, and it'll only gain momentum. But I think the pace will surprise us on the downside in the sense that the adoption will not be as quick as people anticipate because you have to create that infrastructure. I mean, we just about have enough of power to feed mouths, right? So you want to feed cars. It's going to take a little bit of time. And it'll happen in cities first. But where is the infrastructure in tier 2, tier 3, tier 4 cities? It's not there. Forget about rural. We're trying to do rural electrification. We can't do car electrification that quickly. So I think it'll take time, but it's a trend which is here to stay. So that's the first part. New businesses, I'm all for new businesses, but I think we've not invested for two reasons. The challenge with new businesses are twofold. The first is understandability. You got to understand these businesses. All the money that we have lost over the years has not been because we got into expensive. It's because we got into things that we did not understand fully. So I think we have to be very careful about what we understand, what we don't understand, and stick within our circle of competence. We of course expand it as much as possible, but if we cannot understand it, it's better to leave it, let somebody else make money, but we don't want to lose money. So I think that's the first. The second is the valuation that these companies come at. By the time they come to public markets, they're looking at an exit. Public markets for them is an exit point for a lot of these investors. So the valuations come in at very elevated levels. And the business predictability and understandability is a little bit less, right? So if for me at least, if understandability is less, I got to be compensated by better valuations. That's not happening. So we have here a set of companies where there is profitability in some cases is far away in the future. Understandability is a little bit more challenging, and at the same time, valuations are expensive. So that's not the best combination. So we've stayed away from a lot of new age businesses, but I think EV is a trend which will remain for sure.
Thanks, Chirag. Now we have exceeded our time, but let me try and squeeze in a couple of questions. So there is a
last question, Ram.
Maybe one or two questions. Yeah. So can you please explain in layman terms how do you assign stocks PE multiple? I'm just verbatim reading out the question. I'm also not able to understand, but it says that going by the PE multiple formulas, paying anything above 30, 35x seems may not be the right thing to do, but we have a lot of stocks trading at 50, 70, 80 PE multiples. How do you look at them? If in case, probably the question is that if in case the growth and quality justifies those high PE multiples, are you okay to buy them?
I think it's important to keep in mind that there are, investing is not a business where there are any absolutes, right? So it is not, high PE businesses are typically high quality, high growth, a combination of those two. And that's why the PE is high. But if growth falters or quality deteriorates, then those businesses get punished hugely, right? We saw that yesterday in Netflix. Fell by 36%, high quality, high growth business, but growth faltered and the market was sort of merciless in terms of how it treated that outcome. So I think there's nothing wrong with high growth, high PE investing. It is suitable to a certain type of investor, right? I'm more a middle path investor. I don't want to do deep value investing, doesn't work for me. I'm not into high growth, high PE investing, doesn't work for me. I prefer growth at a reasonable price. That's my approach. So I think the key in this business is to do what you're good at. Don't try and mimic or emulate what others are doing. And when you look at your portfolio as an investor, you should have all elements. You should have a growth element to your portfolio. You should have a value element to your portfolio, and you should have a GARP, growth at a reasonable price element. Because the market will rotate. There'll be some times when growth will do fantastically, and then if you only have value, you'll do terribly. If you only have growth when the market is moving towards value, you'll do terribly. So true diversification is to have all styles. So having 3 fund houses, 3 funds, all value is not helpful. All growth is not helpful. So choose a growth style, choose a value style, and choose a growth at a reasonable price style, and I think that'll work.
Sure. So finally, one question I'll just ask from Mr. Ganesh. I think what's Chirag's personal asset allocation? Would you like to?
I am sure. I think a lot of this is in the public domain, so it's not I want to know his asset allocation too. But I am roughly 65% equities, 35% fixed income, 0 in real estate. Actually, no, there's marginal real estate. The reason I'm only 65% is because my job is also market related. So my compensation is 100% equity. So I don't want my asset to be 100% equity and my income to be 100% equity. And then that's a lot of equity I'm okay to deal with it, but I'm not sure how the rest of the family will manage. So I'm 65-35, which I think is, I'm also getting older.
Thanks, Chirag. Thanks for putting it very, very in an interesting way. With that, I'll hand it over to Ashok, who can say a few words, and then you can, if you have anything to say as a final word, you can. finish it off.
I'll add one last bit to the last point, Ram. So as I think about it, the other reason why I'm 65% equities and not more is I still have a house to purchase as a base resident. So I need to also keep some money aside for that. So if that was done with, then I would be closer to 75, 80%.
Sure. Yes, over to you.
Chirag, that was really wonderful presentation, and Ram for very, very well articulating the questions. I think most of them got answered, and shortly we will be releasing presentation of mid cap and small cap, which should hopefully reach you. And if you have any questions, further questions, queries on those funds, please reach out to us, to the branches nearest to you. We'll be more than happy to get it resolved for them. But what is more important, what is the key takeaway? That mid caps and small caps do create wealth for medium to long term investors, for a patient investors. It's very difficult to remain at top in mid cap and small cap because the winners keep changing. There are large, particularly small cap size, that there are large number of stocks to choose from, and therefore winners keep changing. But what is more important is what is the performance over 5 to 10 years. That is key, and therefore SIP always remains a preferred mode of investing in small and mid cap. One more last thing, that do not get bogged down by the large returns or heavy returns that these categories have posted in last 2 years since March 20 bottoms, because March 20 was a very panic bottom. And just for the information, if mid and small have done very well since March 20 bottom, they were the worst performing categories from January 18 top. So January 18 top to March 20, they were the worst performing categories. So the correct way to look at mid cap and small cap is from a 5-10 year perspective. And today what we see, that those categories are lagging behind the nominal GDP growth rate of this country. That means there is lot to catch in terms of its overall growth rate, and therefore make a presentable case for the people to consider investing with a 5 to 10 year view. Albeit SIP always will remain a preferred, because this category tend to be a little bit more volatile, and in fact in volatility you average out units at a lower price as compared to large caps. So with these thoughts, thank you once again, Chirag, for this wonderful presentation. Thank you, Ram, for moderating it so nicely. And
my pleasure, and thank you to all the participants, most importantly for attending. Thank you.
Yeah, thank you everybody. And we can close the call now.
Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.